We'll start today's field hearing with remarks from the CFPB's Director, Richard Cordray. Next, the CFPB's Assistant Director for the Office for Students, Rohit Chopra, and the Acting Deputy Director, Steve Antonakis, will lead a discussion with two distinguished panels of experts on various aspects of student lending and the experiences of borrowers. Following the two panels, we'll kick off the audience participation portion of the field hearing. The audience participation portion of the field hearing provides audience members, that's you, with the opportunity to share your stories and your observations about what you are seeing and experiencing in consumer finance in your community. And today, I'm told we have community leaders, advocates, industry representatives, and of course, consumers. We're also pleased to have with us today staff from the Office of Congressman Alcee Hastings, who represents Florida's 20th Congressional District. And we're pleased to welcome Assistant State Attorney Kathy Berkowitz, as well as Florida Banking Commissioner Drew Breakspear. So let's get started. Director Cordray became the CFPB's director when he was appointed by the President on January 4th, 2012. Prior to his current role, Director Cordray led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you, Zixta. Good evening, everyone, and thank you for joining us for our field hearing on student loan debt. It has long been ingrained in the fabric of our country that if you work hard, study well, and act responsibly, you can get ahead in life. Benjamin Franklin once said, "An investment in knowledge always pays the best interest." From a young age, we impress upon our children that education can be an important milestone on the pathway to opportunity. That has been true in my own life, and I'm sure it's true of many of the people who are in this room today. But a college degree has the potential to become more of a burden than a blessing for those saddled with unmanageable debt in a tough employment market. We have heard from frustrated borrowers across the country. Thousands of private student loan borrowers feel like they have hit a wall. The unfortunate reality is that many private loans do not have the same affordable payment options as federal loans. Many private student loan borrowers have run out of options and are struggling to make ends meet. Student debt has become the defining feature of their lives, the millstone around their necks that holds them back from a full financial future. One borrower, Samantha, told us that she feels like she is, and these are her words, trying to put out a forest fire with a garden hose. Last year, the Bureau released a study describing practices in the private student loan market that resembled some of the practices in the subprime market for mortgage lending before the financial crisis. Although it appears that those practices may have subsided and new borrowers may not face the same risks, many who took out those high-rate loans remain stuck. We've also received complaints and stories from thousands of borrowers who've run into trouble repaying their private student loans. They feel trapped by high interest rates, and some are frustrated about being unable to navigate issues through their loan servicer. We've seen especially shameful examples of poor servicing performance as service members try to obtain the benefits they've earned under the law, but find themselves thwarted by burdensome paperwork and other obstacles. Many of these borrowers did everything right. They worked hard and made years of monthly payments, but they still cannot find any refinancing options to get out of those high-rate loans. This sounds uncomfortably familiar. When I was a local and then a state official in Ohio, I saw homeowners who hit a rough patch and ended up facing similar circumstances. They were not trying to escape their debt. They just wanted to work out a reasonable deal with their mortgage servicer, but no one would help. Consumers were trapped in exotic mortgages with few options, and the repercussions were felt throughout the economy. We learned a hard lesson in the wake of the mortgage meltdown. We cannot just sit by and watch this happen to people again. The Consumer Financial Protection Bureau was created in the wake of the worst financial crisis since the Great Depression. Identifying emerging risks to consumers and our economies is an important part of our mission. So we're concerned that unmanageable student loan debt may be harmful to recovering consumer markets and may be dragging down borrowers' lives. In February, we asked the public how student debt is affecting individual consumers as well as the broader economy, and what should be done about borrowers seeking to lower their payments on private student loans. The response was overwhelming. We heard from nearly 30,000 Americans who wanted to see Washington try to do something to address this issue. Many told us about their day-to-day struggles with expensive loans and steep monthly payments. They also described the life choices they were forced to make in order to stay current on their loans. Many of them are postponing or foregoing major financial milestones like living on their own, starting a family, or owning a home. Others tried to put these choices into context by describing how high monthly student loan payments can diminish personal savings or crowd out other types of consumer spending. What is clear is that the overhang of high student loan debt can constrict the choices many young graduates are able to make about their careers and about the communities in which they live. The potential domino effect of these choices is a particular concern in the housing market. For example, consumers with student loans traditionally had higher rates of home ownership than those without. Because student loans were an indicator of higher levels of education, those consumers typically had higher income and therefore were more likely to buy a home. Today, however, we're seeing some student loan borrowers shy away from such investments. We heard from one borrower, Deborah, who said plainly, "I can't buy a house because of my student loans. I have to rent." Daria was another who told us, "These loans are stunting my growth as a citizen. No car, no home." Census data tells us that nearly 6 million Americans between the ages of 25 and 34 lived with their parents in 2011. The National Association of Realtors estimates that this age group made up a mere 27% of all homebuyers in 2011, the lowest share in the past decade. First-time homebuyers play a critical role in the market by increasing demand and facilitating move-up purchases by existing homeowners. Some of the current generation of first-time homebuyers carries record levels of student debt, and this may inhibit their ability to qualify for a mortgage. On top of that, their high monthly loan payments make it hard to save for a down payment. We heard that the consequences of high student loan debt do not end with the housing markets. College degrees have helped many people start new businesses over the years, and they continue to do so today. Yet the overhang of substantial debt may also stifle innovation and discourage the formation of new businesses by young people. In any business, it's critical to invest funds to hire employees and market your product. But when you're saddled with sky-high monthly student loan payments, those funds can be hard to come by or even to qualify for. Some commenters noted that unmanageable student debt limits their ability to access small business credit. Student debt burdens may require them to divert cash away from their business so they can make monthly student loan payments. Columba was one respondent who told us, "Student debt has pushed off my goal to open a small business by not allowing me to save enough money or even qualify for a business loan." The economic implications of student loan debt spill well beyond housing and small business development and into retirement savings as well. One woman told us she had to turn to her mother, who was trying to save for her own retirement, to help her pay down her student loans. Recent research revealed that only half of workers under 30 have enrolled in their employer's 401k plan, and barely 4 out of 10 contribute enough to receive a full employer match. We are concerned that those struggling with high student loan debt today will have no retirement savings to fall back on in the future. If the consequences of student debt weigh down individuals and economic markets, it's inevitable that they hold back communities as well. Rural areas in particular struggle to attract and retain doctors, nurses, and other young professionals. In many of these communities, car ownership is a prerequisite for employment, and rental housing may be scarce. Young consumers bowing under large debt loads may be unable or unwilling to buy a car or a home. The necessity of doing either may be enough to dissuade them from settling in rural communities. This week is National Teacher Appreciation Week. I can think of many teachers in my life, and I'm sure you can too, who made a strong positive impact in shaping my future. But student debt is hitting teachers too. The problems posed for communities can be seen in the many letters we received from teachers, who often have low starting salaries that increase slowly over time. As a result, their high student loan balances can easily become a permanent fixture in their lives. One teacher who wrote us has been teaching for 12 years and still has over $75,000 in remaining student loan debts. She said that because she has chosen to teach, she does not make enough money to get in front of her student loan debt. We received comments noting that programs to make student debt more manageable could lead to higher retention of quality teachers. A school district official described the lack of options on private student loans as a threat to keeping good teachers. She told us, quote, "This leaves many of our staff members with high student loan payments that may prevent them from staying in the teaching profession." So not only does student loan debt affect borrowers' financial lives, but it may reverberate in profoundly harmful ways throughout our educational system, our communities, and the entire American economy. Consumers told us how high monthly payments have left them trapped by the private student loan debts. They told us how this debt has forced them to sacrifice many of the features of middle-class American life. We heard about how these sacrifices have snowballed to the point where they pose a growing risk to other sectors of the economy. And many offered possible solutions to make private student loan debt more manageable. The Consumer Bureau will be doing its part. We recently proposed a rule that would allow the agency to oversee many of the country's largest student loan servicers. This oversight would allow us to keep a watchful eye over any servicing company that engages in unfair or deceptive acts or practices towards student loan borrowers. We will also continue to cooperate with the Justice Department to hold accountable those who violate the rights of our women and men in uniform. This is certainly something, but the public told us resoundingly that more can and needs to be done. The comments we received identify some potential policy and market-based solutions to help struggling borrowers with unmanageable private student loan debt. The solutions target three specific problems. First, market participants, policy experts, and individual borrowers alike suggest that refi relief could be an option to help borrowers with expensive private student loans who have done everything right. Second, a number of people proposed a road to recovery for borrowers who are in distress on their private student loans. Third, many others outline the need for a credit clean slate applicable to borrowers in default on their private student loans, like the rehabilitation option already available to some borrowers with federal student loans. Let me describe each of these ideas in somewhat greater detail. For borrowers who have dutifully managed to make their monthly payments on high-interest private student loans, one of the ideas that policymakers and market participants could consider is providing refi relief for student loan borrowers. This approach could give responsible borrowers the opportunity to refinance their debt at market interest rates. This approach would make sense because students often apply for private student loans when they're young, have scanty credit history, and have little or no income. Lenders must also consider the possibility that borrowers may not graduate or may not find a job with a salary that allows them to meet their monthly payments. As a result, lenders price new private student loans as if all young borrowers with limited credit present equally high credit risk, and the interest rate on their loans reflects those assumptions by coming in at consistently higher levels. As a matter of fact, however, many of those borrowers do manage to finish school, do manage to get a good paying job, and do manage to make their payments on time. Nonetheless, they're still paying the interest rate of someone who did not yet have any of these attributes. If those borrowers could refinance, their debt would be much more manageable. Given today's historically low interest rates, there's tremendous opportunity for lenders to take advantage of an underserved market. Some people noted in their comments that a robust refinance market for private student loans could provide a break for consumers who have better credit than when they first borrowed and now deserve to have a fair shot at qualifying for lower interest rates. Another proposal could apply to borrowers in distress, including those who have fallen behind on private student loans. Here, people suggested the option of providing distressed borrowers with a road to recovery. One of the reasons private student loan debt can pose such a challenge for consumers is that these loans have less repayment flexibility and other borrower protections than do federal student loans. Most private loans have few options available for alternative payment plans, but those who commented said that if lenders had more incentive to work with borrowers trapped in debt, both sides could benefit. So policymakers might consider creating a potential path forward for those borrowers, a transparent, step-by-step process with affordable payment terms where monthly payments are lowered to match a reasonable debt-to-income ratio. Some borrowers, however, may need more than just alternative payment options. They may already be in default with severely damaged credit. Damaged credit can be a huge roadblock for consumers, making it impossible for them to borrow money for any other purpose, including the pursuit of even their most sensible aspirations. Some in the industry contend that policymakers should create a way for borrowers to repair their credit and get out of default, what might be called a credit clean slate. Something similar already exists for borrowers with federal student loans, a program that can limit some of the negative credit effects of default. With the option of a clean slate, consumers may be able to qualify for a mortgage or an auto loan that otherwise would have been denied, which could open up new paths forward for them to get a firmer foothold to climb the economic ladder. Everyone who cares about the future of this country should be focused closely on the many problems posed by a growing student loan debt burden borne by some of our best young people. What is at stake is whether some of our most motivated and ambitious citizens, who have the talent to make something of themselves but lack only the means, will be able to rise and form part of the future leadership of this nation. If instead their hopes and dreams are diverted, discouraged, and defeated by the crushing burdens of a debt that ruins their prospects, we all will be poorer as a result. So this problem should be sounding an alarm bell for all Americans. At the Consumer Financial Protection Bureau, we've been working to address the student debt problem from a variety of angles. We have an array of online tools and resources to help students and their families navigate the complicated college financing process. Whether someone is just starting to think about paying for college or has already graduated and grappling with loan payments, we have new tools to help inform these decisions. But we know that much more needs to be done to help private student loan borrowers who are finding that they're running out of options. The ideas discussed today are just a few examples of the ways in which policymakers and market participants can work with borrowers to help manage their student loan debt. The pursuit of higher education should not become an insurmountable roadblock to opportunity for many of our fellow citizens. Indeed, it should be the very opposite. It should be a pathway to progress and personal development that strengthens our society. At the Consumer Bureau, we're committed to helping students understand debt before they take it on, helping them manage their debt once they've incurred it, and addressing complaints and concerns they may have about their lenders or loan servicers. When we create more options to empower consumers to make responsible decisions about their debt, we all can benefit. But we can clearly see the gravity of what is at stake, not just for these young people, but for all of us. And we must feel the growing urgency around these issues. I look forward to a vigorous discussion about student loans this evening and to hearing from all of you. Thank you.
Thank you, Director Cordray. At this time, I'd like to invite Assistant Director Rohit Chopra, our Acting Deputy Director Steve Antonakis, as well as our first panel to please join the stage. And while the panelists take their seats, I'd like to take a moment to thank those joining us by live stream. You can access the web link via Twitter or Facebook. Steve Antonakis joined the CFPB in November of 2010 as the Assistant Director of Large Bank Supervision and was named the Associate Director for Supervision, Enforcement, and Fair Lending in June 2012. His background includes more than 2 decades as a financial services regulator. In January of this year, he was named as the acting deputy director, and in CFPB style, he is currently holding both jobs. Since October 2011, Rohit Chopra has been leading the Bureau's work on behalf of students and young people as the Student Loan Ombudsman and the Assistant Director of the CFPB's Office for Students. Assistant Director Chopra, you have the floor.
Thank you very much, and thanks to all of you who joined here today and are also watching online. One of the things that we keep hearing over and over is that student loan borrowers want to make good on their debts. But while those of them with federal loans have been able to find some options, those with private loans haven't always been so lucky, and they often go to great lengths to figure out ways how to make those monthly payments. Some of them reduce their payments on their federal loans to pay their private loans. Some of them move back home with their parents. And through our process of listening to consumers and industry and other leaders, we heard about all sorts of impacts that unmanageable student loan debt has on the rest of us, even if we don't have a student loan. Our first panel today is going to talk about some of those impacts that go beyond just the individual student. We'll first hear from John Corker from the American Medical Association, who serves as the Government Relations Advocacy Fellow. And he'll talk a bit about how student debt is impacting the healthcare community. We'll then hear from Mo Veazey, a realtor here in Miami, Florida, and the immediate past president of the National Association of Realtors, who will talk a bit about the importance of first-time home ownership for the economy. We'll hear from Jennifer Wang, the Policy and Advocacy Manager at Young Invincibles, a youth advocacy group. And finally, we'll hear from Frederick Ingram, who will become the president of the United Teachers of Dade here in South Florida next week. I'll ask each of you to give some short remarks before going into some question and answer. John?
Thank you, Rohit, and thank you to Zixta and Steve, all those involved at the Consumer Financial Protection Bureau for putting on the event tonight. Thank you, Dr. Cordray, for your initial remarks, and of course to all of my other panelists for being here to help shed light on this critical issue. The rising medical student debt burden presents a serious financial disincentive to us creating a representative and adequate physician workforce in this country needed to address the unique healthcare needs of this country, especially during a time of unprecedented reform. Many of you may know that according to the American Association of Medical Colleges, we're currently 16,000 primary care physician shorts across the country. And that physician shortage is projected to grow to almost 63,000 in just 2 years by 2015, all the way up to 130,000 physicians short of what we need by 2025. Those physician shortages will span all specialties and all areas of the country. And at the end of the day, this rising debt burden for students, as I said, presents a powerful financial disincentive to those students choosing to go into high-need specialty areas and high-need geographic areas. For those of you who aren't familiar, the average four-year cost of attendance for a medical education across the country is right in the $250,000 range. The average medical student debt, as published by the AAMC, is right about $167,000. But that figure doesn't really tell the whole story. That average debt is actually a product of what is largely a bimodal distribution. More than 1/3 of medical students who graduate with medical student debt have a debt burden over $200,000, and 1 in 5 students have a debt burden over $250,000. That debt burden is a big factor when medical students are faced with choices to go into residency, what specialty to go into. Contrary to popular belief, the same kind of lifestyle choices that Director Cordray talked about earlier, buying a house, buying a car, starting a family, medical students are faced with those same difficult choices that they put off at the very earliest till when they're around 30 years old, when they're done with residency training, and often even later in order to pay off their debts. Decisions that push them into higher paying specialties, higher paying areas of the country. There's also another aspect that's lesser known about this debt burden, and that is the sticker price of medical school. I talked before is about $250,000. That sticker price is listed as the #1 factor for underrepresented students across the country choosing not to go to medical school in the first place. Only 1 in 5 medical students across the country comes from an underrepresented background, either ethnically or socioeconomically. We're not creating a physician workforce that adequately represents our patient population. At the end of the day, we need to create an environment where the sticker price doesn't scare underrepresented students away from applying to medical school. Personal example, I taught in a summer program at my medical school, Wright State University in Dayton, Ohio, called Horizons in Medicine, dealing with exactly this population, high school students interested in a career in healthcare. And every single one of those students who chose, as they went through college, to not pursue medicine, stated that it was because of the cost of medical school. They thought there was no way that they could ever afford it. We have students coming into medical school through the rigorous admissions process, starting out interested in areas such as family medicine, geriatrics, but by the time they graduate, they choose to go into higher paying specialties so that they can afford to pay back their loans quicker and start their lives. I had a classmate who was president of the pediatrics club at my school for 2 years and just matched into orthopedic surgery a couple of weeks ago. It's a significant issue that we hope that we'll be able to begin to address tonight, and so that we can effectively create, as I said, an adequate and representative physician workforce for our patients in the future. Thank you.
Thanks, John. So, Mo, tell us a little bit about first-time homeownership and how traditionally college graduates were more likely to be homeowners. So how is it affecting realtors and the housing market?
It's a great question, and as I answer that question, I want to recognize the importance of homeownership in America today. First of all, my name is Mo Vesey, and I'm the immediate past president of the National Association of Realtors. We have about 1 million practitioners across the country, not only concerned about student loans as they impact the ability to be able to buy a home in America, but why that is so important to Americans today. We're looking at the Y generation, roughly larger than the boomers were, with what appears to be a lesser opportunity, even with outstanding opportunities in mortgage financing today and the opportunities in the housing market. Our concerns are threefold from the standpoint of financing as they're imposed today. And number one, that is the QM, the regulations that exist today for banks in order to lend to conform. And we know basically today that 43% of the total debt to income standard is a pretty decent standard. The problem is when a young person comes out of college and is confronted not just with the aspects of trying to find a job in a market that isn't as robust as it once was, but also is burdened with student loan, the prospects of he or she being able to go out and start their life the way their mom and their dad did, incorporating a house or a home of some type, is completely, it's not negative, but it's a lot less opportunistic than it was. Now, the second thing is the qualified, or QRM, qualified residential mortgage. There's a rule at the QRM, should it pass, that a minimum down payment of 20% would be required in an effort to get a loan. And that, in and of itself, is not just cumbersome for folks who are already established and ready to go, but imagine somebody in college with a substantial mortgage, with a substantial student loan, being confronted with the prospects of finding a job, become involved in the prospects of the opportunity of owning a home, and then having to deal with the prospects of trying to save that kind of money. We've got statistical evidence at the National Association that says in order to save about 20% would take you somewhere short of 20 years. The third one is the Basel III capital standards. And that proposed rule has raised the cost for banks to hold non-governmental loans and mortgages with less than 20% down, in some cases by as much as 50, as much as 100%. Under that rule, it's cheaper for one of these community banks to go out and find a derivative or foreign debt than it would be to make that loan to a person that's got 5 or 10% down. The reality is simple. This country has depended a great deal upon home ownership in America, not just for economic growth, but because home ownership promulgates a great deal of the social and cultural attributes that we hold so dear. We know that of the 5 recent recessions, 4 have come out because of a strong housing and construction market. We know that for every 2 houses that are sold, 1 job is created. So even in the worst of times, over 2 million jobs were being pumped out in the real estate industry in America in 08, 09, and 10. We know that for every home that's sold peripherally, about $58,000 to $60,000 worth of additional financing, worth of additional income is created in the community that exists. And we know that of the 75 million homeowners in America today, they pay about 91% of all the personal income tax in this country. Look, the reality is quite simple. Of the renters in this country, the equity base is about 5,000 to 7,000. Of the homeowners in this country, the equity base is about $150,000 to $160,000. But there's something else that is enormously important that sometimes we forget about when we talk about home ownership, and that is the social and cultural benefits of the people that live in a home in America today, uniquely different than any other place. We know statistically that the kids that live in that home make better grades in high school and college and go on to get better jobs. We know that the families that live in that home have longer time, longer marriages. We know that they are healthier. We know that there's less teen pregnancy. We know for a fact that those folks have less crime in the community, more involved in communal affairs. We know that home ownership is not just an underpinning for the economics of America. We know that it is a huge stalwart for the social and cultural benefits of America. So while we aren't here to administer specific recommendations, we are concerned about the opportunities that might exist not simply for the folks that exist today, but those that are coming out to buy a home. It's enormously important that we make sure that the opportunities for those folks remain as robust as possible.
Thanks. Jennifer.
Thank you, Rohit, and thank you so much for everyone for coming out tonight to discuss this important issue. I also want to thank the CFPB for its hard work in protecting students and borrowers. So my name is Jennifer Wang, and I'm the Policy and Advocacy Manager at Young Invincibles. We're an organization that was founded in the summer of 2009 out of the recognition that young people's voices were not being heard in major national debates that impact our future. We engage in research, policy analysis, advocacy, and education campaigns around higher education, healthcare, and employment issues. So student loans are in the minds of young people across the country, and more so than even a decade ago. Young Invincibles recently sent an online email survey to more than 1 million people and received responses from roughly 9,500 individuals who had private student loan debt. And we submitted over 7,000 responses to the CFPB. Our survey shed light on some of the worst practices of private lenders. Our respondents are part of a self-selecting sample, so our results do not necessarily mirror the experiences of the entire population, but these student debtors have a high level of concern, if not distress. They attended public, private, and for-profit institutions, came from all over the country, and had varying levels of degree attainment. And given their responses, we can say with confidence that their experiences reflect the concerns of many borrowers who need help. And their stories are absolutely heartbreaking. Private lenders often give struggling debtors no chance to even keep up with their payments. 42% of borrowers said that they were in financial distress and that it was very difficult to make their monthly payments. And we've seen some private lenders who were completely unwilling to negotiate with borrowers and often leave them in the dark. Almost 40% of our respondents said that their private lenders were completely unwilling to negotiate new terms when they were struggling or were unresponsive. I want to share one story from one of the respondents, Michelle. She said that she graduated from college with a biology degree and lost her job while still owing over $50,000 in private student loan debt. And when she contacted her private lender to negotiate better payment options, they told her that because she lost her job, she was no longer eligible for their reduced payment plan, and that her payments were going to increase. She told us that the private lender said that this was because she could no longer prove to them that she could pay the amount that she owed each month on the reduced plan. Her monthly payments are now causing her financial distress, and she said that she's taken on credit card debt to make her payments, and she's also shared that she's put her life on hold. She's put off buying a house, she's put off buying a car, and she's put off starting a family, and she's definitely put aside less to save for her future. So if these individual stories of struggle aren't enough, there's also a growing mountain of data out there pointing to a potentially large impact on economic behavior. Recently, the Federal Reserve of New York released data demonstrating that student loan debt is constraining young people from participating in broader economic activities like purchasing homes and cars. And the experiences of our survey respondents certainly reflect that shift. About 47% of the borrowers that we spoke to said that they've already put off buying a house to keep up with their student loan payments, and about the same proportion told us that they've put off buying a car. A full 15% of borrowers told us they'd been denied a mortgage because of their debt. And borrowers told us that they took other extreme measures in an often futile attempt to keep up with their unaffordable payments. About 28% of borrowers have taken on costly credit card debt to keep up with their student loan payments. A quarter of them said they put off starting a business. About 35% said they put off starting a family. A full 76% said that they put aside less money to save for their futures. And even more have borrowed money from their friends and family to keep up. So it's really no secret that all of these changed behaviors could have serious macroeconomic impact. I want to share another story quickly. Another respondent, Pam, said that she has over $35,000 in private student loan debt. And she told us that she graduated from college and she tried to start her own business doing internet sales. But she said that her private student loans took a toll on her credit score and that she was denied credit for anything that she tried to purchase to start her business. And like so many others, Pam said that she tried to negotiate repayment options with her private lender. She initially asked for deferment and later requested to consolidate her loans or reduce her interest rates, but her private lender refused on all accounts. Pam said that one lender sent her loan to a collection agency, and now she said that she's going to have to spend the next decade or more digging herself out of a hole, possibly delaying her parents' retirement well into their 70s. So whether it's the high payments that all too often lead to default or a rejection on a mortgage application or a discouraged young entrepreneur, the impact on young people in our economy could be enormous if things don't change. Lawmakers and regulators should take steps to reform the private student loan market and give these borrowers access to affordable payment plans. They should have relief during times of economic distress, and they need refinancing and modification options, and ultimately relief through bankruptcy for those with nowhere else to turn. So thank you for allowing me to share this info with you and share some personal stories of some of our respondents, and I look forward to a really good discussion.
Thanks. Frederick?
Thank you very much. And I will be brief because I think the director did a very good job at talking about the educational issues and the teacher's perspective. But let me try to tie this in just a little bit. From the healthcare perspective as it applies to teachers, we have about 25% of our teaching force in Miami-Dade County who subsidize their children's health care on government assistance. And we also have about 38% of our workforce that are priced out of buying a home anywhere in Miami-Dade County. If you go across the county line to Monroe County or Collier County and Broward County, it gets even worse. So what's the incentive to attract, retain, and reinvest in the educational and teaching force? Now, these are our folks that are going to tell our students and tell our kids that education breeds success. And 50% of our teaching force in Miami-Dade County are saddled in student loans and student debt. So what are we teaching? Sometimes you're juxtaposed in your classroom instruction simply because of your own personal situation, through no fault of your own. These are folks that have done everything that society's asked them to do. You grow up, you get good grades in K-12, you go to college, and then you come back and your debt ratio is negative for the next 20 years. Something's uniquely wrong with that picture. So let me say this. I'm a teacher for the last 15 years. My wife is a teacher as well. We both have master's degrees, and we both pay student loans today. I will be 40 years old I guess in the next 6 months. I'm not looking forward to that. But I will tell you that I won't finish paying my student loans until my first born son, who's 14 years old, is in college. And there's something inextricably wrong with that picture because, again, I've done what society's asked me to do. And I knew that I would not be rich teaching ever. But I wanted to give back to a community, wanted to give back to my community, and it was important to me to do that. So it is my hope today that we can proffer some suggestions. I love what the director said today. He gave some very, very poignant rules that we can follow by, and I hope that we have more suggestions from you. Let me finally say this. The President of the United States finished paying his student loans at 43 years old. And again, that is just another prime example of the leader of the free world who was saddled in student debt simply because he went to college, not coming from a background that was in a socioeconomic situation that would provide for him to have the financial situation that would not allow him to have those student loans. So we have some problems. We have to change these things. I wanted to just let you know that this is Teacher Appreciation Week, and I think this is one of the best ways to appreciate teachers and try to understand what teachers actually go through, because student loans is one of the major issues that our educators face in our schools today. They're doing hard work. They're doing hard work under duress through no fault of their own. And they're making their student loan payments, and they can't see the light of day or at the end of the tunnel. It is uniquely unfair to doctors. It's uniquely unfair not to be able to afford a home in the place that you live in, because what this system tells us is don't become a teacher, don't marry a teacher, and definitely don't teach your child to be a teacher. And that's unfair, because you want your child's teacher and your child's school to understand that success is going to be because they have a higher education. And if you are in a situation where you as an adult have not prepared for your child's upbringing in terms of their higher education, then a student who is going through school should not be in a situation where they're saddled with 25 to 35 years of debt, and that is what's happening in America today. So I thank you for having this. The director, you've made some very, very crucial points, and I'm looking forward to a robust conversation. Thank you.
Thanks. Jennifer, I was wondering if you could say a little bit more about small business and entrepreneurship. In history, usually when times are tough economically, it's actually a time when many young people start businesses. So what are you seeing on that front, and how does student debt play a role?
So we heard a lot from our respondents that, that the thought, crossed their mind, but it was just a completely impossible route for them to take just because they were saddled with so much debt. And these are people who need help, and they're people who are frustrated because they've got all this debt, and some of them weren't approved for loans to start their businesses. A lot of them took hits to their credit and couldn't start businesses because of that. And so it's certainly a problem that we're seeing from our students.
And so, John, you mentioned that there's a primary care shortage. So if you could explain a little more. So people choose after medical school to go into residency, and then how do they go about making that choice, and how do they factor in their student loan payments?
Sure. So first of all, for those who are not familiar out there, when students graduate from medical school, they are doctors, they are MDs, but they're not allowed to treat patients. They need residency for that. They're basically doctors light or apprentice doctors. They need to spend 3 to 5, sometimes as many as 8 years training to be an independently practicing physician. And during that residency training period, they make about $50,000 a year. An income-based loan repayment payment for federal student loans during that time is about $450 to $500 a month. And then you also have to factor in private loan payments, which don't have an income-based repayment option and are often much higher, and are often what worries students during that initial time during residency training when they're not bringing home that much. So when students have to make their specialty choices, they go into residencies that are specific to a specialty. Right now, when I said we're 16,000 primary care physicians short, that includes family medicine, you know, the doctors that you see when you're a little kid all the way through when you're much wiser. I'd like to think, Frederick, you're turning 40 years young, 40 years wise, but certainly not 40 years old. And we appreciate all that you do in your profession. But they choose which specialty they have, and typically family medicine, pediatrics, internal medicine, and obstetrics and gynecology, the physicians that help young ladies bring new life into the world, are considered primary care physicians and by and large make a smaller salary than specialists. They still make good money, plenty of money, but not nearly as much, about half as much as medical specialists would, a urologist, an orthopedic surgeon, or the like. And so when students are graduating from medical school, choosing which specialty they'd like to choose a residency in, ultimately this huge debt burden that they're saddled with at the end of graduation is one that significantly guides their decision as to what specialty they want to go into, and also, just as importantly, which geographic area of the country they want to go into, because physician shortages are all over the country. They span rural areas, high-need urban areas, every state, every city, every municipality. And in some of those higher-need rural and lower socioeconomic urban areas, these shortages are more pronounced. These physician shortages also cover all specialties, but are more pronounced in those primary care, lower reimbursing specialties. And medical school is the most expensive, most time-intensive graduate degree that students can choose to pursue. So as President Obama says, let's be clear here, students don't go into medical school to make money. They choose to go into medical school to fill a need. And that need has never been more pronounced in this country than it is right now. Will continue to get more pronounced if we continue down the road that we're currently on. And again, it's especially pronounced in the highest need areas and the highest need specialties for our patients.
So Mo, you talked about mortgage qualifications, and your organization put out some data about how people fund down payments. So first-time home buyers, how do they generally fund those down payments, and how long does it usually take them to accumulate it?
Well, as I mentioned, we've done some studies, and today, if we were looking at a QRM rule and 20% down payment was instituted, we think, based on the research we've done, it would take close to 20 years for the folks coming out of college to be able to get enough money to make a down payment on a house. The reality simply is that those folks that are coming out of college with a substantial debt burden already, and in a job market that isn't as robust as it was a few years ago, don't have the opportunities to start to build equity and feather their nest egg like their mom and dad did. The ability to be able to build equity for your own individual entrepreneurial basis, for your kids' education, for your retirement, for a myriad of things happens when you start that chain of home ownership. It's enormously difficult to do that when you start out in life with a debt that is substantial, as we've heard, somewhere between $35,000 and $200,000. And it's very difficult with lenders today, under the circumstances that they're imposing, to be able to loan under those conditions. So you don't start the cycle that folks have been accustomed to doing. They're not, and by the way, no one in America aspires to be a renter. Everyone in America aspires to be a homeowner. So the reality is that when you take that away, you take away the underpinnings, not just of the economic stability of the country, you take away the underpinnings of the cultural and social fabric of the country.
Good evening. Thank you. Welcome and thank you for joining us this evening. I am the child of two teachers. Not sure I made an economic decision when I decided to be a bank examiner rather than a teacher, but nevertheless, appreciate you all being here tonight. We spoke, you all spoke to some extent about the sacrifices folks are making that carrying heavy student loan debt. Could we drill down a little bit more specifically for those with heavy student loan debt, low income? You know, what have you witnessed generally in terms of what some borrowers have done in order to maintain those payments? So rather than focusing on, you know, holding off on life decisions, what other ways have you seen that folks have been able to, you know, manage that high debt burden with low income?
I'll take a shot at that. One is a GI loan. That's good in-laws. There's a lot of folks that are going back to their parents and looking for assistance on a financial basis. And we're not even talking about the things that we've heard about, which is to extend the credit on your existing cards. So, and that impacts the folks that have anticipated a retirement. Their kids now need help. There's not a family that I know of that wouldn't come forward and say, sure, I'm going to help you out, by delaying their retirement, obviously, by doing that. That's one.
And at least within the medical profession, as I mentioned, the residency training level is the most acutely difficult for students. And during that time, students can choose, or I guess physicians at this point, resident physicians, can choose to put their loans into forbearance. And basically what that means is they don't have to make payments on their loans, but the interest that they're accruing accrues on a capitalized principal. So when they're in school, say they took out $50,000 for that year, they're only paying interest on that $50,000. The interest doesn't lop onto it in one big sum. But during residency, when they're graduating with over $200,000 of debt, a large portion of which has interest rates of 6.8% for federal direct loans, 7.9% for graduate plus loans, and sometimes even higher for private loans. Those interest rates are accruing on that huge principal, lopping onto the principal, and then for 3 to sometimes as much as 8 years, they're paying that interest rate on the much bigger accruing principal, which is a very damaging choice for future physicians.
I would like to say that the student debtors that we spoke to, it seems like they're making really tough decisions, like obviously trading student loan debt, private student loan debt, for even higher, credit card debt, and taking dings to their credit. But a lot of them, I think, are also, spending less time with their families because they're taking on second jobs. We heard from a respondent who has a PhD and is a psychotherapist, and he said that he had to take out a second job because he took out private student loan debt to get that PhD, and he regrets not being able to spend time with his family at night. I think that, we heard from some students who said that they had to make tough choices, like not paying for internet every month, and not having utilities, or making decisions to completely cut off those utilities. And so those are just some examples, and I think that they show that young people, truly are struggling when they come out of school.
This is a question for Frederick. Do the teachers that you represent earn raises for getting advanced degrees, a master's degree? And if so, do teachers ever need help to cover the cost of an advanced degree? And what are some of the things that they do to cover that cost?
Sure. So let me give you just some examples. For a teacher who comes in the field of education with a bachelor's degree, they make $38,000 here in Miami-Dade County. If you ascertain a master's degree, then you are awarded $3,000 for that master's degree. Most master's degrees amount to between $30,000 and $35,000 here in Miami-Dade County. That's an average. So again, when you do the ratio of what you have to pay back, does that $3,000 actually pay for itself? Absolutely not. So, and if you have a PhD in Miami, then that's a $5,000 raise. $5,000 raise, which the mean of the PhD system here in Miami is about $50,000 or more. And for public educators, it's a disincentive to continue your education, and that is just simply antithetical to what we're trying to do in the classroom. We're trying to teach our students what is going to breed success is that you further your education. But again, there's a reality to paying for that. Just to go back to your previous question, teachers, that I know, some of the stories that I gained. That I gathered before I came here. I know teachers that are riding bikes to school. I know teachers that have are rooming together, that have lost their houses. We know many teachers, and Jennifer said it best, it is tearing away at our family fiber. When you have these types of student loans, that amounts to financial issues between couples, and it is causing divorce rates. It's causing domestic violence. This is a serious and all-out assault on what we know is family principles and values, because we say that education is supposed to breed some semblance of success. And when our teachers are struggling, that means that our students and our schools are going to struggle. That means that we're preparing ourselves for a future of disincentives when it comes to this student loan debt. So teachers are really, really underwater, and we need to start, somewhere where we can modify these student loans and that we can actually teach our students that education, becoming a doctor, owning a home, and those kinds of things are benefits to going to college if you pursue that. Because most of our people who come to Miami-Dade County are coming in on a $38,000 pay scale, and they're coming in with $50,000 of debt. And somehow their debt ratio is going to be negative for 20 years down the line.
So thanks to the first panel for that discussion. I just want to welcome our next panel up to the podium, and we can start talking about some of the ideas and solutions that the public has put forward. So while we change panels, one of the things that many of us have heard here in South Florida is that the economic crisis and the crisis in housing actually has a closer link to the student loan market than we think. And many people have found that their parents, without much equity in their homes, when their savings went away due to some unemployment, it led to more people needing to borrow student loans in order to pay for college. So joining us on our second panel is some experts from industry, consumer advocacy, and think tanks who might talk about some of the solutions. First is Rob Lavitt. He's the general counsel of SoFi, a student lending startup company. Next, we'll have Deanne Lunan, the director of the National Consumer Law Center's Student Loan Borrower Assistance Project. And finally, Ann Johnson, the director of Campus Progress, the youth division of the Center for American Progress, a Washington-based think tank. Rob?
Thank you very much, Rohit, and really appreciate the opportunity to be here tonight, and certainly want to applaud the CFPB for its work in this area. So I'm the general counsel, as Rohit said, of a startup student lender. We're a new company that has a little bit different take on this market. What we do is we connect students and alumni, and the alumni, both graduates who have student loans as well as alumni investors, through dedicated lending funds. And our goal is to lower debt burdens and foster community, not just make a loan. And how do we do that? Our primary product and how we started is a private education loan that refinances for graduates who have good credit. It refinances their high-rate private student loans as well as high-interest rate federal loans. And we offer fixed-rate loans with an interest rate that's lower than most private loans and lower than the federal Grad Plus loan and the federal subsidized Stafford loan. So we offer borrowers a choice of term, 5, 10, or 15 years, and we believe we save those borrowers money on their student loans. We started operations in 2012. We've made about $100 million in loans. As I mentioned, we foster community in a variety of ways. And how we do that, we provide opportunities for career enhancement for our borrowers. We're putting events on, bringing business leaders in to talk to them about their career development. We're providing a program for entrepreneurs who are borrowers to give them an opportunity to present their ideas to our alumni investor base. And finally, when one of our borrowers loses their job, we reach out to our community. With the borrower's permission, we'll go to our whole borrower base and alumni base and ask them for help, incent them to help the borrower find a new job, and it's worked. While we have a limited history, we have 0 defaults. So we believe our model is working. Notwithstanding our success, we're facing a lot of challenges in accessing the capital markets to augment our alumni investment base. We have about a $300 million backlog, so there's a tremendous demand for our product, and we are just now really figuring out the solutions to access the capital markets. So what could be some of the solutions? What are some of the recommendations on how the government could help stimulate a more robust refinancing market? And I think there are at least 3 or 4 different recommendations that we have, one of which would be, and I know this is outside the purview of the CFPB, but we think that the Securities and Exchange Commission should implement the Jobs Act. There are particular provisions there on private placements, on crowdfunding, that we believe that if those provisions are implemented, it will allow us to find more alumni investors and broaden our base. We believe also that the government regulators should look at providing some flexibility to financial institutions to invest in unrated student loan securities, because we as a startup, the 3 big rating agencies, and you've all heard about the rating agencies, they require a 3-year operating history. So while we think we have really good credit in our portfolio and very strong borrowers, we're kind of in that catch-22 because we can't really develop a rated security that would allow us to expand our lending. So we are lucky that in today's interest rate environment, we are starting to have some success even as an unrated issuer. But we believe that having that flexibility for the banks to not just blindly look at a rating, but actually look at the underlying quality of the assets would help us. And finally, we think the government should look at maybe a TALF-like, and TALF is Troubled Asset Loan Facility, that was implemented in the financial crisis to kind of jumpstart some of the financial markets, that might help facilitate a more robust refinancing opportunity for a broader group of borrowers. And finally, while this is a little off the point of refinancing, I think we've talked a lot about private loans, but you also have to understand that the government is the largest lender, and so most borrowers have, they have substantial government loans as well. And I think I think the schools have to be looked upon maybe to take some risk sharing and share in the risk. They're receiving a lot of support from the government, and really they don't bear any risks. So I think that's an opportunity. I think if those were implemented, I think that would help borrowers in the long run as well. Thank you again. Appreciate the opportunity.
Deanne, I know you had some thoughts about how loans are, whether they can be restructured for certain borrowers. Could you share more about that?
Sure, thanks, and that seems like the right distance from the microphone. Thanks to, I have a loud voice, so thanks to the director and to all of you for inviting me here today. And just briefly, from the National Consumer Law Center, we're a nonprofit group based in Boston and also have a small office in Washington. And our focus really is on consumer justice issues for low-income consumers. And I do work, in addition to policy work, I represent individual low-income borrowers. So one point I wanted to make before I go through a couple of solutions is that I think the clients who we work with really show what a broad face, the broad faces of student loan borrowers. We're not just talking about young people on the traditional path through a 4-year college anymore. They're certainly an important population, an important segment of the student population, but what they call non-traditional students are actually the majority of students now. So working adults, people with their own dependents, they're really often the clients who we're working with, and frankly often don't have a safety net that a lot of other folks have. Most of our clients have both federal and private loans. I would say the one thing that everybody has in common is that everybody was trying to better themselves through education. For a lot of people, getting from point A to point B is not always a straight path, and I think in terms of economic impact here, what we want to talk about is all the important issues that people have brought up already in terms of consumption, but also giving people a path who maybe didn't succeed the first time around in college to be able to go back to college, be productive in terms of jobs, and then contribute to the economy. So a lot of our clients were devastated really by private loan borrowing. We certainly see people with federal loans too, but from some of the predatory lending practices in the past. So the two areas of solutions that I want to focus on are first, making sure that that predatory market does not come back again. We want the new market that's reemerging post-credit crisis to be a fair market, and unfortunately there are a lot of parallels to what happened on the mortgage side. Fortunately, there is a lot of responsible lending going on now on the private side. So a lot of the lenders have moved on. The problem is that a lot of the borrowers have not been given that chance. And that's where we're talking about some solutions for relief for those borrowers who were harmed by the predatory practice in the past. And hopefully, if the market is responsible going forward, there will be relief for those borrowers too. There hopefully won't be as much of a need for some of those solutions. Bankruptcy relief, which is something that Congress needs to do, is not something we're going to go into great detail here, but really giving people the fresh start through bankruptcy is critical. And then something that we talked about in a lot of detail in the comments that we submitted, so I won't go through all 45 pages or whatever it was here, but what Director Cordray called a road to recovery, we think should be a very high priority among the federal regulators and among Congress as well. Some sort of loss mitigations and modification options for borrowers. The lenders right now are not doing enough to help people, and there are a lot of ways that this could be done. There are a lot of lessons that we should learn from what's happened through the foreclosure crisis and some of the modification programs that have been created through those to help people who were in foreclosure. And we have 5 principles that we think that these modification programs, these principles should be a part of any program. And then I can take questions about details later, but just to go through those principles, first of all, the modifications must be affordable. So we're talking about not just kicking the can down the road through some forbearances for a while, we're talking about some real structural long-term relief so that people can succeed. Make sure that we preserve borrower protections through this process, that the borrowers have enforceability rights if the servicers or others don't go along with the program that they're supposed to go along with. We want the program to be efficient, and finally, we want it to be fair. And when I talk about fairness, this is not intended to be a bailout for the lenders. This is really something that the lenders who made a lot of the predatory loans are not necessarily going to come out, with 100% buyout from what they've done. We want to make sure, though, that it still is a win-win situation so that the incentives are there for the servicers and the private lenders to provide relief and the borrowers to be able to afford and get back into repayment.
Thanks. Anne?
Yeah. Well, thank you so much for convening this really important conversation. It's an issue that Campus Progress has been working on for a long time, and I think if we've been hearing through the last panel and this issue of student debt is enormous, and we're seeing the ramifications throughout the economy on individuals and collectively. A couple things to keep in mind, I think, is that 2/3 of people who graduate from college now graduate with student loan debt, 2/3. The average amount of debt that people graduate with is $26,500 in debt. That debt cumulatively is about $1 trillion in student loan debt. That $1 trillion is broken up into 3 different big chunks of loans. The FFEL loans, which are government-backed loans, federally government-backed loans, the direct loans, which are the loans that are being used now through the federal government, and then there's this private lending market with private loans, where there's about $150 to $200 billion that is being lent privately to cover education expenses. And this is a huge increase over the last 10 years. There's 37 million people in the United States who have student loan debt. 37 million people. Half of the people who have student loan debt are actually over the age of 30, and 15% of people with student loan debt are over the age of 50. So this is not just an issue that affects 18 to 22-year-olds, right? We traditionally think of people taking out loans. This is an issue that affects 37 million people across socioeconomic, geographic, different jobs and categories around the country. So what have we done? As a result of all of this work, Campus Progress, we launched a campaign called It's Our Interest, which is sort of a solutions-oriented campaign. And our goal is to bring together a coalition of these borrowers and of people who are affected by student debt to actually advocate for some real solutions to some of the problems that we're seeing and really raise the public presence in this debate so that we have enough sort of public pressure to create sort of political change on some of these issues and to change the system. So I think some of the things we need to do, one is we need to deal with the existing $1 trillion of debt. We need to talk about affordability and quality in higher education, and we need to think about the role of Wall Street and some of the big banks in servicing the loans and how we can make sure that they're not profiting off the backs of students and not profiting off because of this debt. So I think on refinancing, that can be a really great option to lower monthly payments for borrowers and help them be able to manage their debt more effectively. So within those three buckets of loans, there's different ways and different mechanisms for refinancing. So the direct loan program is the program that the federal government uses now to refinance. So one of the things that we talk about in our comments is the possibility of moving some of the other loans into the direct loan program. Some of the benefits of that is there actually are some really good consumer protections in the direct loan program. Things like income-based repayment, so that you can peg your monthly payment to the amount of money that you're actually bringing in. And there's other consumer protections that really benefit borrowers. So moving some of the loans, whether they're the FFEL loans, which are the old loans, or some of the private loans, into that, into the direct loan program, we think could be really beneficial. The government actually borrows money right now at less than 2%, 1.97%, and lends it back out to students at 3.4, or 6.8, or 7.2, depending on the kind of loan that you're getting. So what we're thinking about refinancing is that the federal government should be trying to figure out how to pass on these savings, historically low interest rates, to borrowers so that borrowers are able to actually address their debt, manage their payments, and be able to get ahead of the debt, as we've been hearing stories of people talking about today. We also talk about the importance of expanded protections on private loans. So having options for repayment is hugely important, and we've heard stories of borrowers who want to repay their loans. They can't figure out who to call to try to negotiate a different sort of payment structure, and once they do find someone to talk to, they're told no over and over again. So you've got to figure out ways to give borrowers options to repay. And there's other kinds of policies that could be really useful, things like know before you owe, so that schools actually have to certify private loans before borrowers are actually using them, which would be great because then students and borrowers would be making sure that they're taking out all the federal loans that have a little bit better consumer protections before they go into the private lending market. So I think that's another important thing to think about. And lastly, I think, and most importantly, as a solution, is people need to tell their stories. People need to talk about what student loans are doing in their lives. They need to talk about the effects that they're having on their family. I started working on student loan issues, and I couldn't believe the number of my friends who were sort of sheepishly like, I didn't really want to talk about this, but I have $80,000 in debt and I can't buy a house. And like, it is so huge, and I think it's really important for people to be able to talk about it, for people to share their stories and talk about what it's like to be in default and talk about what it's like to have servicers calling you 40 times a day. You have to tell these stories so that we can actually get people engaged and involved and create the public pressure.
Thanks.
Yeah.
So Rob and Deanne, you've both actually suggested that there should be maybe some role for the government. And my, just to challenge you both on that, banks have lots of deposits. Why aren't they just refinancing the loans themselves and offering this product to borrowers with student loan debt? And Deanne, why are banks not restructuring loans themselves if they might have a higher probability of actually collecting on that debt?
I can start. I mean, it's a very good question. I mean, I often wonder sometimes why some of the banks haven't entered into that refinancing market. I think part of the problem is private student lending has really shrunk, actually, and most of the lenders who were in the private student loan market exited the market, so you have a relatively few lenders in that market space left. And I think the traditional banking institutions also kind of have this push and pull between the prudential regulators who may make it difficult for them to give some of the restructuring options to borrowers. So I think it's an excellent question. I don't purport to know all the answers, but I mean, I do think that there are some issues there, with the interplay between the prudential, traditional banking regulators and those banks that maybe inhibit them from doing a restructuring. And the other thing is that most of these loans, most of these private loans have already been, and I don't want to get into too much complexity, but they've already been sold into a asset-backed financing structure where there are, covenants and limits on, I think, what the lenders what the holders of the loans can do. So I think it is a difficult question, but I would expect, that I think we are really the first ones to focus on this refinancing market, and admittedly, we're not serving the whole market right now. We have a subset of it, but I would expect others, would find it, because I think it's going to be an attractive asset class for investors, because I think we've talked about people who graduate and have a job are now in a much better position to pay back their loans. Dan?
Yeah, I mean, I really believe that there are situations where there can be a win-win for the borrowers and for the creditors and the investors, and I don't know why, in a lot of cases, I negotiate with the lenders myself on behalf of my clients, and I can tell you the kinds of things that I hear, and I think we all need to get to the bottom of whether these are real barriers or just perceived barriers or frankly just excuses. One is the regulatory guidance that Rob mentioned, and we don't know, honestly, to what extent this is a barrier. I do honestly believe that a lot of lenders believe that it's a barrier. So I think that one thing we can do is find out whether the safety and soundness principles that are important that the regulators have out there, to what extent they really are impeding relief, to what extent we can do something about that. I also think that the securitization I get that excuse or that point sometimes from servicers who say, this isn't ours, it's in a trust, and we're not the ones who can act on it. Excuse me. So I've looked at a lot of trust agreements, and I don't necessarily think that it is a barrier, but if it is, then let's deal with that also, just like we've done in the mortgage. Excuse me. I almost never lose my voice. And the other thing I was going to say, excuse me, is that a lot of the lenders are selling the debts to debt collectors, and in many cases, they're able to get judgments that by entities that don't necessarily even own the debts. So I think it's a loose market out there. What happens to these private loans even after somebody defaults? So if that was tightened up more, just like if bankruptcy was restored, then that would be another way to give lenders more incentives to work with the borrowers.
So just to follow up on that, Rob, we hear of small financial institutions, credit unions entering this business. Just give us more of a flavor. Why aren't some of the bigger financial institutions, even if they don't have a student lending business, why aren't they entering this market?
Well, there was something that I wanted to add to the question, and I think it's I think that there are lenders who are refinancing private student loans, but I do think that financial institutions are reluctant to refinance federal student loans. And federal student loan, and it's not everybody who should refinance their federal student loans, because federal student loans do have protections that private student loans don't have. For certain borrowers, though, a private student loan at a lower rate may be the right answer. But I think from the financial institution standpoint, I think that there's the mantra that has been kind of ingrained that federal loans are always superior. And, you know, if you look at the $1 trillion of student loan debt, I think, you know, the vast majority is federal student loan debt. Probably 900 billion of that is federal student loan debt. So I think when you talk about a refinancing market, and I think people don't realize that the federal government interest rate, other than the subsidized piece, the subsidized Stafford, is a high rate. It's 6.8% or 7.9%. It's fixed.
This is a question for all the panelists generally. Thank you very much for helping identify some of the pieces of a well-informed, substantiated policy discussion on this. It's very important. Deanne, in particular, you laid out 5 principles, including affordable mods, the preservation of protections, enforceability rights, efficiency, fairness. These are all positive takeaways that we can glean from the recent housing crisis. What are some of the lessons that we should apply in the negative context? That is, what are the things that we shouldn't be doing, that we should just take off the table because we recently went through a crisis and we saw that these things didn't work?
I mean, one thing that I can say, and a lot of the lessons, I think, hopefully I'll keep my voice here, are from the HAMP experience, the home ownership modification program on the mortgage side, which as a lot of us have to remember that there was almost no modifications being done on the mortgage side prior to HAMP. So even though HAMP has been criticized for a lot of reasons, you know, it has had some success. But the servicer non-compliance has been a huge problem with HAMP. And so when we talked earlier about the servicers and the incentives, we really need to figure out, I think, what the reasons are why they're not doing some of this restructuring now, to help us understand the incentive structure on the service side and make sure that if it is an incentive-based solution, that we both have incentives that work and that there's some kind of enforcement on the oversight side, but also to consider a model that's not purely incentive-based that way for servicers, and something along the lines of some of the suggestions that Rob mentioned too, where there might be some government support for the program so that it's not just a market-based incentive solution. And I think the other last thing I would say from the HAMP experience, to make it more efficient, you know, there's always a compromise, a balance that if you make it more efficient by having some standardized criteria for eligibility, then some people may get in and some people won't, but excuse me again, to come up with some standard way of determining that. Sorry.
For Ann and Deanne, this may be an impossible choice, but what is the greater priority for you? Is it focusing on existing college debt or focusing on future lending to new college students?
Yeah, I think they're totally interconnected. You can't sort of separate them, right? You have to address the existing $1 trillion of debt because of all the conversations that we've been having about the big, broad economic consequences of this debt. So you can't just say, well, that's in the past and let's look at interest rates for current borrowers. Because I don't think that's a big enough sort of conversation about the system of higher education, because I think the whole system kind of needs us to be looked at. We need to figure out how are we funding higher education, and you know, how is it structured, who has access to it, you know, should college cost $40,000 a year? And I think you can't separate those two conversations because they're totally interconnected. And I also think that it's important that the borrowers, the existing 37 million borrowers, are involved in the conversation because they're experiencing what it's like to live with that debt. And so if you're only talking to 18 to 22-year-olds or people who are just starting school or going back, they don't know what it's like yet to live with a $50,000 debt and be a first-year teacher making $32,000 a year. And so you have to have the people in the conversation who are actually dealing with it to be able to I think, talk holistically about the problem and the solutions.
Well, thanks to the three of you for joining us on this panel. We really appreciated the discussion, and please thank our second panel. before we go on, just some quick updates on what the Consumer Financial Protection Bureau is doing. So the Bureau is responsible for making sure that consumer laws are being followed. So we're responsible for ensuring that servicers, debt collectors, and lenders are following the law. Whether it's collectors of federal student loans that have gone into default, or lending by private institutions, and we've also proposed a recent rule to oversee certain student loan servicers of both private student loans and federal student loans. But I also wanted to share some resources that are available on our website for consumers to figure out how to pay for college, pay for debt, that are available to all of you. Does this work? Okay. So our website here at consumerfinance.gov has a lot of resources for families navigating paying for college and college costs. Our first initiative that we embarked upon with the Department of Education is the financial aid shopping sheet. So this time of year is when many students and their families are comparing financial aid offers between schools. And we developed this shopping sheet with the Department of Education so that families have clear information on a single page about what it will cost to go to college and what loans they might take on, as well as some estimates of how much debt they might have when they leave. Already 700 colleges have adopted this shopping sheet, including this one, Miami-Dade College. The next is our paying for college tools. You can take your electronic shopping sheet from your school or other financial aid offer and upload it into an interactive tool. You'll be able to create scenarios as to how much you'll be able to contribute, your family will be able to contribute. You can play around with how much loans you might take on in order to estimate what will be your monthly payment when you graduate. You can choose between private loans, federal loans, and adjust for scholarships or adjust how much it might cost you to live on campus versus off campus. And already tens of thousands of consumers in recent weeks have been taking advantage of this. We also have our Repay Student Debt tool. It's often challenging to navigate the slew of options that you have when paying off student loans, whether it's a federal loan, a private loan. There's benefits for service members, teachers, but our easy interactive tool has allowed tens of thousands of consumers figure out what the best repayment option is for them and to figure out the right buzzwords to use when calling your student loan servicer. And finally, our student loan complaint system. Borrowers of federal student loans or private student loans can come to consumerfinance.gov and we'll be able to intake your complaint electronically. Already, so many consumers have been able to get errors corrected and in many cases, refunds. It's not just student loans that you can come to the CFPB with. Checking accounts, mortgages, credit cards, and many other financial products. You'll receive a tracking number to track the status of whether or not the financial institution has processed the complaint yet, and we review complaints after they've been filed to see trends in the market and to see whether there's been any violations of the law. So we also have Ask CFPB. A compendium of frequently asked questions where you can ask questions and get clear answers that you can trust. We have information on all sorts of financial products, and you can get clear explanations with step-by-step instructions on how to take advantage of resources. So you can visit all of these at consumerfinance.gov. You can follow us on Facebook and Twitter and stay involved to be able to be part of our work.
Thank you, Assistant Director Chopra. Now it's time to hear from you all. The open mic portion of today's field hearing is an opportunity for us to hear your perspective about today's discussion on student loan affordability. but to also hear about some of the consumer finance trends and practices in your community and here in Florida. Each person will have 2 minutes, and what we hear from you is invaluable. We want to hear from as many of you as possible, so I strongly encourage you to please observe the 2-minute limit so that everyone who has signed up to provide comments and testimony has the opportunity to do so. So our first audience participant is Paula Zamudio, and either Chris, there he is. Chris is going to bring you a mic.
Hi, my name is Paula Zamudio. I am a student here at Miami. I go to FIU, Florida International University, and I am undocumented. And today I've heard of stories of everybody going into debt. Unfortunately, being undocumented, I cannot even apply for a student loan. So that's a dream of mine, to be able to apply for a student loan and possibly get into one of those debts that we've been talking about today. I have other sorts of debts. I've had to go into credit card debts, and we all know credit cards, once you default once, your APR goes up. I have over, I think it's about 4 credit cards that I am maxed out on just school, paying out-of-state tuition. That's never fun. It's 3 times the much as tuition as everybody else has to pay in state, so you can just imagine how much student loan I have on just my credit cards. I've had to get loans from out of country, from my family back in Colombia, my home country. So I really do owe money around the country. So that's a different sort of debt than we've been talking about today. But the question I have is, what about our school? I mean, I grew up hoping to going to school, getting an education, getting a bachelor's degree. You know, eventually we heard this gentleman talking about being a homeowner, what a dream that is. That for me is 50 years down the line. I don't even want to think about owning a home right now just because I know I don't have the money to do that. My thing is, what about next semester? What about next year? What about my peers, my cousins, my friends' little brothers and sisters? What about when they go to school? Are they going to be going to school with tuition for $100,000 for a public institution? Where can we cap that? Can we cap that? Can we do something to make sure the people that are giving us loans don't go crazy when we can't pay them back, when we have to defer, if you are given that option of being able to get a loan? So that's where my question comes around to the panel, to everybody that's here today. What can we do about helping not only the undocumented community with possibly getting loans, but also capping the loans, capping the tuition that colleges give us? Every year they're going up for no apparent reason. They keep going up while our salary stays the same. You know, is there something we can do in that aspect?
Thank you, Ms. Zamudio, for having the courage to share your challenging, what you're facing. I don't think there's an easy answer to the many questions that you pose, but part of getting to the right outcome is making sure we understand what the issues facing young people in this country are. So thank you for that. Camilo Rosa.
Thank you very much for this opportunity to speak in front of all of you. It really is an honor to share my thoughts with you. And like Paula, I here am as well an undocumented person, a student. I graduated in 2006 from the Miami-Dade program, School for Advanced Studies. And it's taken me about 6 years to complete my associate's degree through a lot of hard work. Like Paula, I have been paying out-of-state tuition. Thankfully, I had some savings and was able to pay most of my tuition, but I also racked up quite a bit of debt on my credit cards. That's the biggest issue that I have, as Paula mentioned, being able to get some sort of student loans for continuing my education. I have been accepted to a professional health program, and being that I am not a citizen, I find that doors are closing in terms of loans here and there, and that's something that's very unmotivating to a lot of us. and at the same time, it sort of crushes your dreams. Now, I think that something that could definitely help out opening up the minds of lenders is showing that a lot of us that actually do end up working for our educations end up appreciating them a lot more than those who are often given the opportunity straight out of high school. For that reason, I believe that in addition to credit, one of the things that lenders could look out for, especially when lending to students, are their grade point averages, the types of colleges that they get into, the types of programs that they get into, as these are signs of how capable we are of contributing to our society with the community service that we do, the motivation that we try to spread among our community members, and hopefully we hope to one day be citizens of this country and be able to contribute for the welfare of everybody.
Thank you, Mr. Rosa, for your courage and your insights. Dan Glazer.
Hello? Hello? Okay, thank you. So I am a rising third-year student at the University of Miami Miller School of Medicine. I'm pursuing my doctorate in medicine and also a master's in public health. And I'll be 34 when I finish my clinical training. I will have no savings and hopefully a whole car that I will own, but potentially not. I will also be in excess of $250,000 in debt, most likely. And the biggest thing for me that I fear is I go to class with 51 other dedicated, hardworking, brilliant students, all interested in serving minority communities, underserved communities, and groups that traditionally don't get the advantages of healthcare. And what I fear is that they will be driven away from those careers in leadership, in public service, and in nonprofit work, where true change can be made in the healthcare of our country. And I think that without changes to our loan burdens, that the number of people choosing to pursue these opportunities is only going to get smaller and smaller and smaller. That's my comment.
Thank you for the thoughtful observation. It's appreciated. Kathy Berkowitz. Aldo Martinez.
Hello, everybody. My name is Aldo Martinez. I am as well an undocumented student. And the thing that concerns me a lot is the fact that banks, financial institutions, harass you whenever you want to go and open an account. I know that's the main goal of a bank, to have customers. And when you try to go to a bank as a non-documented person, it's very difficult because when you go in, you're afraid, right? Because of all the questions and all the harassment that you get from them. I know from personal experience, and it was very uncomfortable, it was very difficult. Some of the questions were like, why would you ask me this? And I'm saying because I opened an account with one bank, and it was very easy, it was painless. It was practically like a walk through the park, you know, it was really easy. And then I went to the other bank, trying to open another account as a savings account, and when I went in and they started asking me all these questions, and it was like, why would you ask me this if the other bank didn't? So I don't know, that's just a really big concern of mine, which is like, why would you harass this certain group of people and discourage them from, you know, giving you profit, if you will? So that's it.
Thank you, Mr. Martinez. Angel Vallejos.
Hello, my name is Angel Vallejos, and I have recently graduated from FIU. I attended Miami-Dade College, and I experienced one of the biggest bittersweet moments of my life, because aside from going through that grueling process of validation, I didn't have a means to actually, the moment as soon as I shook the dean's hand, I realized that I didn't have the means to pay back my student loans. And that thought, I sincerely thought, is going through the minds of many young Americans who recently graduate. Young Invisibles is an organization that's helping young Americans, counseling them through the ways of how to pay back their student loans. And one of the stories that they collected was from a young recent graduate named Josh. And Josh said that he has to make a decision every month whether he can feed his wife and himself or pay his student loans. And the reality is that this isn't something that should happen in the United States of America. We are punishing those who seek the means to get ahead in life, and that is just wrong. This gentleman right here said that the current system is crushing his dreams. I want to ask the CFPB if they can picture a United States of America where dreaming can no longer happen. Thank you.
Thank you, Mr. Vallejos, and thank you for the work that you do. Dr. Flora Latortre. Mr. Majka.
Thank you for holding this forum. There are a lot of people out there in my situation. I'm not going to talk about student loans of my children or my grandchildren. I'm talking about my student loans. As we just had the recent recession, a lot of people changed careers. I did it when I was 40. I became a nurse. I worked in oncology, bone marrow transplant. I got my bachelor's degree for nursing. I got my master's degree in nursing. I accumulated $66,000 in loans. I got my postmaster's paid out of pocket. My doctoral classes, I unfortunately had a scholarship. I'm retiring next month with still $57,000 in loans, and I paid over $40,000 in interest. I mean, if you want people to go back to work who've been laid off like I was, somebody's got to give us a break. I just can't. I have to continue working part-time to pay that $450 a month. I can't live on Social Security. Only thing that's fortunate for me is my family, the men died when they were 75. When I die, my student loan still won't be paid off, but it'll be gone. Thank you.
Thank you, Mr. Majka.
If I can add quickly, I think some of the comments we've already heard have showed that student debt doesn't just come in the form of an official federal or private student loan. It can come in the form of credit card debt. It can come in the form of borrowing from your retirement savings. It can come in the form of home equity loans. So it may be an even bigger credit issue than the numbers state.
Patricia O'Reilly.
Meeting. I've been moaning and bemoaning about student loans for probably 5-7 years, ever since 2008 when a piece of legislation was shoved into the middle of a farm bill, and I ended up with losing $200 out of my Social Security disability check to pay student loans. Now, I'm not in an argument over whether or not to repay my student loans. I did not have a massive stroke in order to avoid paying my student loans. Okay? I ended up with a massive stroke, and I already owed, I had paid for all my education except my last year, which was in 2000. I took a year off out of my life, and I went back to school and finished my bachelor's degree after 33 years of struggling paying course by course, okay? I had the stroke without finishing my last course. It took me 2 years to get back up on my feet and finish the course and graduated in 2003. In 2006, I started a master's program in special education because I had been volunteering for a number of years with this Center for Independent Living, and I saw a real need to teach special education. So I had to do something with the rest of my life. I couldn't do what I was doing, so I went and did that. So those 2 years of education caused me to run into a big problem with student loans because I couldn't get back to work, okay, and ended up with a full-time disability. The farm bill killed me because they garnished my disability check. my disability check after the couple of bills I pay, and the student loans left me with $20 a month and no ability for food. I couldn't qualify for food stamps because the food stamps, the money that I used to pay the student loan that was garnishee for my disability check is considered discretionary spending. And because it's discretionary spending, that means that I can choose between buying food, paying for medications, paying for Medicare treatment. Even though I have Medicare, I still have to pay 20%, of my drugs or my health care. And I only had $20 a month left to do all this stuff. And they don't consider student loans, they consider discretionary money. So I can't qualify for more than $16 a month in food stamps. And when they put the bill through, they didn't change the issue of discretionary spending. And it's killing me. I was homeless for 4 years. I've done everything I can possibly do. And I don't begrudge them the $200. I just like to be at the point where I could go get food stamps.
Thank you, Ms. O'Reilly, for sharing that with you, and thank you for having the courage to go through all that and tell us about it.
I would say that that's one of the arguments that we heard a few years ago for the healthcare reform, was people being forced to choose between, paying the rent, paying utilities, buying food, and buying medicines. And the fact that student loans enter into this debate throughout people's lives and on into retirement, as we're hearing, or disability is a notable reason for people to be motivated about addressing this problem as well.
Hardeep Slavia?
My name is Hardeep Saluja. I'm a medical student at FIU Herbert Wertheim College of Medicine. John did a good job of representing the medical profession when he was in the first panel talking about the deficiency in health practitioners we have in our country. So the major thing is we qualify for deferment on federal loans while we're in medical school. Why can't we qualify for deferment when we're doing residency? It's also a part of our training. We're not making our full salary yet. So can the Department of Education consider offering deferment to MD residents while they're doing their residency training? And since the CFPB is a federal agency, you have a direct link to the Department of Education. Maybe you can talk to them or do something to see if, medical students can get deferment while in residency training, because that would help a lot. Thank you.
Thank you. Nicholas Wolf? Sebastian Aroca?
Thank you, everyone. I graduated from Miami-Dade College, associate in art degree. Then I went to FIU. I got my bachelor's and my master's in international business. I started a small business in 2007. I have a debt, Stafford loans. My payment it was set for $265 a month. What I did is I'm paying $450 a month, so I'm paying over what I need to pay because I was told that I could pay off the capital and reduce the amount of years that that my debt needs to be repaid. Also, my servicer is Nelnet, and they have a program where if you pay with automatic payments over a couple of years, I think they reduce 0.25% in the interest rate. So what I would like to share here in this panel is, number one, for those that are starting now, try to apply to grants and scholarships as much as you can. I think I heard only once someone mentioning scholarships. I think we need to talk more about that for future generations. For past generations like mine, I would like to encourage officials to create programs for incentivize repayment and accelerate repayment. I think we hear a lot about debt relief, bailouts, but I think the majority of us would like to repay our loans, and we would like to do it sooner. So I think I would like to see maybe 10, 15, 20% discount for payoff. I would like to see, what about if we pay 5 years consecutive payments without missing a payment? What about a reduction of interest rates? What about if we want to purchase a home, which I put off for so many years? What about maybe a tax incentive for those that have a student loan and want to purchase a home so they cannot keep putting it off for 5, 10, 15 years? So I'd like to see incentives. That's where I'd like to see our imagination, our energy going forward.
Thank you, Mr. Arroca. Daniel Lodizo.
I don't have a student loan per se. My son does. He graduated Johns Hopkins. He's a musician, got scholarships, lots of money. Gave him a package deal to help balance off the rest. I said, sign him, sure. I thought it was like federal loans. You know, they make some kind of arrangements. They wouldn't give you a loan you couldn't pay back, would they? Well, they did, because his payments after 4 years at school came to almost, with the federal loans, it came to over $1,000 a month. Now, I don't know very many students who come out to the workforce that can make $1,000 a month. Federal loans, he went into the IVF or IBR or whatever, so that one was taken care of. But the private loans, well, he went over to school in the Netherlands to do another 4 years there and put everything on forbearance, or couldn't get a deferment because they didn't recognize the school there. Now he's there for 4 years, doesn't want to come back. Why should he come back? Gets a job, he's not going to have any money left over. First of all, he won't get a job. He does early music. Nobody's going to hire him to play music. They hire him to play music there in a better time. So no job, no income, but he doesn't want to, default. I don't want him to default. But he doesn't have very many options. And I think the part of what I'm upset about is the way the loan was administered. Ignorance is no excuse, they say. Okay, sure. But if the school hands you a package and says, here, you think they're doing you a service. They're there to help you as a student. And that was at the time when I think Columbia and Johns Hopkins also were involved with steering students to different lenders. A little bit of a controversy. Slap on the wrist, a few $1 million into a fund, great. Mortgage thing went down, slap on the wrist. The banks got bailed out. Students aren't going to get bailed out. I'm hearing people say, I want to pay back the loan. Yeah, I want them to pay back his loan, but let's get real. $250,000 after, my son's loan is up to $94,000 now with the interest. At the rate it's going, he's never going to pay that back. And I don't think it's right that they gave him that problem in the first place. I feel guilty.
Thank you for your courage in sharing that, Mr. Lodijo. Edwin Ramos.
Hello, everybody. Thank you for this opportunity to speak. My name is Edwin Ramos. I am a Miami-Dade College student. This year, I'm actually the Newman Civic Fellow for the Miami-Dade College, so yay. And I'm studying to become a teacher. A career that a lot of people say no to. A career that people say, why are you doing that? You're not going to get nowhere with that. And after sitting in this panel, I actually started questioning my career because, well, people say, it's funny, but it really isn't, because that was my dream job. And listening to how how if I want to continue my education, I have to go through loans, but knowing that Florida, you know, it's not really good with education, they're cutting down sometimes, like they cut down on salaries for teachers. It's tough to love your job and try to support your own life. So, you know, I'm currently not in loans right now, but when I want to continue on my education, I will be. And now that's what gives me, you know, that's what questions my career. You know, am I doing this out of love? If I do this out of love, what's gonna happen to my own, you know, my own personal life? You know, and that's why I came here, and I thank all of you for speaking and that. But that's what I want to keep y'all in mind, that teachers teach the children. Teachers are the pathway, you know, they create that pathway for children to continue on their education. And I feel that our state legislators are not putting in their minds that the teachers are what teaches students how to do math, how to do English, how to speak, how to write. And I feel like not a lot of people are looking at that right now. And they're looking down on the teachers, cutting them off, while some lose their jobs, some leave Florida, and they continue doing other things with that money. That's why. Thank you all for letting me speak.
Thank you, Mr. Ramos.
So I just want to make sure many of you know that if you have federal student loans, there are a number of special benefits for teachers. There are forgiveness benefits if you teach in underserved areas. There is a public service loan forgiveness program where you can activate the income-based repayment option, and after a period of years, the rest of the loans will be forgiven. And there are a lot of those options. Some of them are complicated, and we explain them all on our website, but not all loans, of course, have those options.
Thank you. LaShonda West. Tomas Pendola.
Hi, everybody. I want to thank the CFPB for putting together this amazing event. My name is Tomas Pendola. I'm a student in St. Thomas University studying chemistry. I'm also undocumented. And for those of you wondering where all these undocumented students come from, we represent a group called Student Working for Equal Rights, abbreviated SWEAR. We work for the rights of undocumented students and families. My comment that I wanted to make was the fact that we do talk about, you know, the current loans, and we do talk about fixing the whole process of loans and how people pay them back. But there's areas that we're not really talking about, such as future flow of the requesters of loans. Things like, for example, recently in the immigration, deferred action got passed, and a lot of us are DACA members, meaning we have a Social Security and we have some sort of credit now. And we can take private loans. We can take out federal loans because we don't get those rights. But we can take out private loans, which is something that we're not really talking about. We're not really talking about things like the increasing number of people taking out loans. Because in reality, every year, there's more and more people taking out these loans with the same increasing rates. And we need to look at that and not only fix the rates themselves, but the reasons why people take out loans. Because if we don't fix all this increasing number of people getting these loans, then the problems are just going to keep increasing. It's just going to be less money per person, but more people.
Thank you, Mr. Pendola. Devin Feher.
Hello, my name's Devin Fair. I just graduated, actually, it's been a year now from University of Miami, and I've had a lot of difficulty finding a job. I got a degree in urban design, which isn't the best one in this area. I mean, I've tried to find internships that can at least pay a little so that it's not so difficult for me, but it's not possible in this part of Florida, so I'm thinking of moving, maybe Northwest, Seattle, somewhere like that. But this is the last month my savings account will hold out, so I'm gonna have to sell my car next. And the training that I'll need, computer training, that sort of stuff, is gonna cost money, and it's really difficult for me right now. So University of Miami charged a lot of money for what I got. I don't feel like the program was worth the $54,000 the savings the loan's going to cost me over time. But it's really difficult. I had to pay $600-something a month, and I had to refinance it, so I won't pay the loan off until I'm 50 years old, $330 a month at least. And that's going to be most of my income if I can find a short-term job, some kind of temporary work, but I've had a lot of difficulty locating an employer, and I just don't know what I'm going to do in the short term.
Thank you, Mr. Fair. I have to say, this is one of the most inspiring and one of the most touching field hearings that the Bureau has held. I think it's fairly clear that what's happening in the student loan market is having an impact not just on our economy and economic recovery, but on the lives of people, your lives. And I cannot thank you enough for helping us inform the policy debate that is facing us as a nation. And I really want to reiterate our thanks for your courage in coming here tonight and sharing your difficulties. Thank you.